You would have probably heard that in terms of auditing standards, there are some presumed risks, which means that in any audit, you have to presume that these risks are present, and because they are presumed significant risks, there are certain consequences for your audit approach. I'm going to take you through those presumed risks. There are three specific ones, and there's one that's rather general, but it's something that you need to know about. But the three specific ones that I'm going to take you through, you'll see coming up. The first risk, in no particular order, it's just in that order because that's how it comes in the auditing standards, is that we must always assume that there is a risk of fraud in revenue recognition. So in revenue recognition, because it's so easy to manipulate revenue by changing your cutoff or changing your recognition criteria, etc., you can manipulate profit quite easily. You can manipulate the entire results of the company quite easily. We are saying, or the standards are saying, that even though you have done a proper risk assessment and analytical review and whatever else, and you haven't found a risk in revenue recognition, you must still presume that there is a risk in revenue recognition. Okay, that means when I say revenue recognition, I mean both ways. I mean completeness, overstatement, and understatement. So completeness and the others, all the other assertions you have to look at. That you will find in ISA 240, paragraph 26. It's a presumed significant risk. But please note the word rebuttable there. You'll see that's the only risk on my screen of all those risks that is actually rebuttable. What does that mean, that the risk is rebuttable? It means that you can, if you have sufficient reasons, document why you do not believe that in this audit it is a risk. And it happens quite often if you do, for example, a property company that's only got 12 rentals, and 12 times the annual, the monthly rent is your annual rental. There's no risk in revenue recognition. You only recognize it one way, and there really can't be a fraud risk. So in that case, you can use that as a reason as to why you do not consider that to be a significant risk, and then move on. Then you don't have to, excuse me, then you don't have to specifically deal with that as a risk. As far as the others are concerned, they are not rebuttable. The other two are not, the following two are not rebuttable. Please leave the last one out, the number 4, because it's not specific. So the next two risks are not rebuttable, and they are, that then means that they are considered significant risk. Not until proven otherwise, they are significant risks, and you have to deal with it like one would deal with significant risks. Okay, so I'm going to show you on the last slide how you deal with them. So the second risk, that is a presumed risk, is the risk of fraud due to management override of controls. Because management is always in a position where they can override controls, and because the override of controls will just about negate all the other assessments that we've had as far as the reliability of controls, etc. is concerned, the standards say that you must always consider a management risk of override of controls to be a fraud risk in every audit. That's a risk that's always present, it is always a significant risk, and you always have to deal with it. I will show you just now again how to deal with it in Probe. As I said before, that is not rebuttable. That means that it stays a significant risk and you deal with it. The second one, also not rebuttable, but you will see that it's only present, sorry, the third one on that screen. Also not rebuttable, but you will see that it is only present in certain circumstances. So it's only there if it is applicable. And it is applicable when there are three things present: significant, related party transactions outside the ordinary course of business. So first of all, there must be related party transactions. If there are related party transactions, you must ask if they are significant. If they are significant, you must ask if they are outside the normal course of business. If all three of those are true, then it is a significant risk, and it will stay a significant risk. You cannot rebut that presumption either. It stays a significant risk throughout the audit. So those are the three presumed risks that will always be present. In fact, the first two will always be present. The third one will only be present if those conditions are met. The fourth one just says in ISA 240 paragraph 27, it says that any fraud risk that we find must be considered a significant risk. Fraud risks are automatically significant risks. So we don't really normally include that as part of our 3 presumed significant risks, because you need to find the risk first before it is a significant risk. The other 2, the first 3, you don't need to find it. You can consider that they are there and then deal with it from there onwards. So it's very essential, very important that you understand, or that you actually not only understand, you must memorize those first 3 risks. Remember that they are there and you have to deal with it. In the file, you have to show somewhere, in every file, doesn't matter what the size of the audit is, every file you must show how you have dealt with those risks, why you think that they are, why you think that the first one is not a risk, and how you have dealt with the following 2 risks. Okay, so that's the presumed significant risks. Now I will move on to how do we deal with it in fraud, and in probe. How do we deal with it in probe? If you look at probe, I'm going to, and for the ease of this presentation, in the webinar presentation, I've actually cheated a bit and I just put screenshots on. I'm not going to show you the live probe software. It just makes it easier in a webinar not to be jumping around and waiting for everyone's screens to update and so on. So it's much more effective to do it with screenshots. But I can promise you it looks exactly the same in the live software. The screen that we're looking at now is your risk assessment at the surgeon level. So when you click on the assess risk button, you will see that this risk is already listed. And I'm looking at the revenue section specifically. You'll see that that risk is already listed. You can even, you can then submit it. Once you've submitted it, it looks like my screen looks now. So I'm showing you 1160 with that submitted risk. All you can do is you can go and edit it. You can right click on it and edit risk. And in this case, you are allowed to remove the button next to significant risk. I'll try to show you with my pointer. I don't know if you can see the pointer on the screen. You can unselect that box there next to underneath significant risk. Why? Because this is a rebuttable risk. So if you find that it is rebutted, then you can unselect it, and then you have to give your reasons. The standards say specifically that you have to give your reasons why that risk has been rebutted. All right, so that was 1160, where the risk of fraud in revenue recognition is recorded. Now, how do we respond to it? For that, we need to go to our audit plan and strategy, which is found in 1220. So if you look at 1220, you can see again it covers the risk. The source is just a paragraph quote from ISA 240. It covers the risk, says what the risk is. Do you need to have all of these last columns I would have recorded when I recorded the risk, so I'm not going to talk a lot about that. I would also have noted any specific audit procedures in the audit procedures column, which I didn't do when I prepared this case study, but I suppose in practice you would see the specific audit procedures, because as I will show later, if it is a significant risk, there has to be a specific audit procedure. There must always be a specific audit procedure for every significant risk. And that's how you deal with the risk of fraud in revenue recognition. It is recorded automatically in 1160. It is populated automatically in 1220. All you need to do is when you go to the record risk, when you edit that, you can right click and edit it, you must put in a specific audit procedure. And then that then gets carried forward to your audit program. I didn't bring a screenshot of the audit program, but you will know what it looks like. The audit program is just a normal audit program with the significant risks and the responses at the top of the program. That is specifically the revenue audit program. Okay, and the next risk that we're going to look at is the risk of fraud due to management override of controls. It happens in the same way, but it is recorded in a different place, because this risk is a pervasive risk, meaning it's a risk at financial statement level. It doesn't affect a specific item in the financial statements or a specific assertion. It affects your entire set of financial statements. So it's not recorded in 1160 as the others are. This one is recorded in 1140 with your fraud risk assessment. Once again, when you go to the bottom of 1140, on my screen you can see I'm on the last tab here. If you go to the last tab, bottom of 1140, you will see that there is already a risk recorded with the source referring to the auditing standard, the risk, the implication, significant, etc. You can right click on it and you can edit aspects of it. What I like to do is in the implication, edit the specific implications for this particular client. What you can't do is you can't delete it, because this is a presumed significant risk and it's not a rebuttable risk. So you can't say, oh, for this reason I don't think it's a risk in this particular client. It has to stay a risk and it has to carry forward. So what I'm showing you now is 1140 where the risk is initially recorded. Next we need to look at where the risk is actually responded to. And once again we go to 1220. If you go to 1220 you will see that the risk is recorded there. The risk is responded to there. The screenshot that I'm showing you now is where the risk is recorded again. I didn't put a screenshot in for the for 1220, but you'll see it in 1220 on the first tab. Okay, and the last one that we're going to look at specifically is significant related party transactions outside the normal course of business. Once again, the same principle applies. You can see that there's a sorry, I think, let me just see my slide. Oh, sorry, I was on the wrong slide. Sorry, carry on. This is the significant related party transactions outside the normal course of business. This is where it's recorded in 1160. Similar idea to the first one that we showed, revenue. Why? Because it also affects a specific section of the audit, and that's a related party section. So you record it in 1160, and you use the same mechanism that you would record any risk. But what you can see is that, again, you can't edit this column. This column, the description of risk column, you can't edit. You can't edit it, but you can audit the implication column. I hope you can see my pointer there. You can audit the other column, edit the other columns to make it appropriate to your specific client. That is how the risk is recorded. How is the risk responded to? Once again, on 1220. So all of these are recorded, and then they end up in different parts of 1220. In this case, once again, I should have recorded a specific audit procedure in this column over here. I didn't do it when I prepared for this case study, but when you do this in practice, you would have recorded a specific audit procedure, and that then gets carried forward automatically to your related party audit program. So those are the three risks that we have to look at, and that is how you respond to it. Now, what does it mean if something is a significant risk? What does it mean? First of all, what is a significant risk? If you look at the auditing standards, significant risks are defined as risks that require special audit attention. You'll find that definition in the beginning of ISA 315. So by definition, if something is a significant risk, it requires special audit attention. Or the other way around, if something requires special audit attention, it is a significant risk. That is the definition. Please remember what it means. Then what does it mean once you have identified it as a significant risk? The following things. One, you have to understand all the controls relevant to that particular risk. You don't have a choice. The controls that are relevant to that risk, you have to understand them, and you have to evaluate the design and implementation of the controls. You have to then perform specific substantive procedures. I mentioned it a couple of slides ago already, that once something is a significant risk, there must be a specific substantive procedure related to that significant risk. And what I don't have on this slide is that there's also, if it's material, there must be, not if it's material, if it's significant, there must always be tests of detail performed. And the last one is, if you choose to rely on internal controls in this case, you'll remember that normally or often you can rely on internal controls by testing it once every second or third year. You don't have to test it every year. But that is not true for controls over significant risks. If it's a control over significant risks, you have to test that control every single year. You have to test it every year if it is still in place. You can't use this rotational basis of doing it. So that's just what it means when something becomes a significant risk. And as you will now see, or as you have seen, you can never say that you don't have any significant risks. There will always be some significant risks, at least the first or the second two that we discussed. So in summary, those are the risks. Risk of fraud in revenue recognition, that is the risk that is rebuttable, meaning that if you have a good reason, you can say why you don't consider it to be a significant risk and you can move on. But the following two are not rebuttable. The risk of fraud due to management override of controls and the risk of material misstatement in significant related party transactions outside the normal course of business. Those are not rebuttable. So there are those risks, if those conditions are present, they will always be a risk and they will always be significant risks. And just a footnote at the bottom, all fraud risks are also considered significant risks. You'll find the principle of significant risks quite a few times throughout the auditing standards. For example, where there's significant estimation uncertainty in accounting estimates, etc. But those are not automatic risks. Those are risks that have to be assessed. What you have on the screen here are the items that are automatically risked.